Okay, if you've been anywhere online in the last few days, you have probably seen the absolute panic, right? The comment sections are just filled with anxiety and fear, and people declaring that the sky is officially falling. I know a lot of you have just started investing, so this kind of volatility can feel, well, incredibly scary. So let's dive into this and actually make some sense of all the chaos.
And this is exactly what I'm talking about. This is the kind of comment that is just flooding social media right now. From stocks to crypto, it really feels like everything took a nosedive all at once. And you know what? It's a completely natural reaction to want to hit that big red panic button. But before you do that, let's just take a breath and look at the actual numbers.
And yeah, here are the numbers behind that panic. As you can see, the S&P 500 had its biggest drop in almost 2 years. Now, I know a 3% fall might not sound like a huge number, but for a major index, trust me, that is a massive move. We're talking billions of dollars. And you can see it wasn't just the S&P. The Dow and the tech-heavy Nasdaq took some serious hits too. So no, you're not imagining it. This was a really big, widespread drop that got everyone's attention for a good reason.
So here's how we're going to tackle this head on. First, we'll look at what's actually happening in these shaky markets. Then, we are going to break down the count 'em, four key reasons behind this drop. After that, we'll put together a solid investment game plan for you. And we'll wrap it all up with a really powerful takeaway I like to call stairs and windows. All right, let's get right into our first section. What on earth is going on with these markets? To really get why they react so dramatically, we have to remember one fundamental, core principle. So think of the stock market as a crystal ball, or, at least it tries to be one. It is constantly trying to predict the future. So the second it gets even a tiny whiff of a potential recession on the horizon, it tends to react first and ask questions later. This recent drop is basically the market pricing in a future that it's suddenly gotten very, very nervous about. Okay, now for the real core of our analysis, the four big reasons that triggered this sudden downturn. Understanding these is absolutely the key to seeing the full picture and not just, reacting to all those scary headlines. These are our four culprits. First up, rising recession fears, and they're based on a very specific indicator. Second, some really confusing signals about interest rates. Third, a pretty significant stumble among the biggest tech stocks. And fourth, a kind of surprising international ripple effect that comes all the way from the Japanese yen. Let's break them down, one by one. First up, those recession fears. Okay, so recent unemployment data triggered something called the SOM rule. Now, what's really wild about this rule is its track record. Get this, it has a perfect score. It has predicted every single US recession since World War II. That's why when this particular alarm bell rings, economists and investors, well, they take it very, very seriously. And as you'd expect, that SOM rule trigger had an immediate effect on what the experts think. The investment bank Goldman Sachs basically responded right away by raising its probability of a US recession in the next year from a pretty low 15% all the way up to 25%. That is a huge jump in what they see as the potential risk. Now for our second reason, interest rates. This one's a little tricky. The Federal Reserve has been hinting at cutting rates, which historically has been like a flashing red light that a recession is coming. But, and this is a huge but, context is everything here. In the past, yeah, rate cuts were a desperate move to save a failing economy. This time, it's different. The Fed is thinking about cuts because they've actually been successful at fighting inflation and they're getting close to their 2% target. So it's more of a victory lap, not a sign of panic. Okay, let's move on to our third factor, the big tech stock tumble. You might think, hey, I'm safe. I'm just in a broad index fund. But this chart shows why that's not exactly true. Just look at this. That one slice represents only 7 tech companies, but it makes up nearly a third of the entire S&P 500. It's kind of crazy how concentrated the market has become. It basically means that when these 7 stocks catch a cold, the entire market gets the flu. And right now, tech has a serious cold. The hype around AI might be creating a bit of a bubble that's starting to lose some air. Warren Buffett's Berkshire Hathaway just slashed its stake in Apple by half. Apple's big Apple Intelligence launch didn't really wow investors, and NVIDIA just announced delays for its next-gen chips. Each of these things creates a major headwind for the very stocks that have been holding the whole market up. And finally, our fourth and most complex reason, the Japanese yen. Stick with me on this. For years, traders used this really clever trick. They'd borrow money in Japanese yen for almost zero interest and then go invest it somewhere else for much higher returns. But that whole party came to a screeching halt when the Bank of Japan unexpectedly raised its interest rates. This forced all those traders to scramble and sell other assets, like US stocks, to cover their suddenly more expensive yen loans. And that caused a huge wave of selling pressure.
Whew. Okay, that was a lot. We've gone through the fears, the signals, the tech trouble, and the weird global ripples. We get the why now, that the most important question for you, for all of us, is still on the table. What do we do about it? So what's the game plan?
And this brings us to the most practical, most important part of this whole explainer, your investment game plan. We're going to outline 3 clear, time-tested strategies to help you navigate this kind of downturn without giving in to the panic. The plan is actually pretty simple, but it's powerful. First, the principle of buying the dip. Second, the importance of being truly diversified. And third, maybe the most important of all, the absolute necessity of focusing on the long-term game. You've probably heard this classic investing quote before, and there's a reason it's a classic. When everyone else is panicking and selling and there's blood in the water, that is often the moment of maximum opportunity for people who can keep a clear head. Think about it. A market downturn is basically a sale. You get to buy the same great companies just at a discount. And if you need proof, just look at the COVID crash back in 2020. I mean, if you had invested $1,000 right before the crash, you would have been down over 30% in just a few weeks. It felt terrifying. But if you just held on, your investment would have completely recovered its value in just 7 months. Patience was rewarded and panic was definitely punished.
So here's the crucial takeaway from all that. A loss is only on paper until you sell. Hitting that sell button during a downturn is the one and only way to lock in your losses and guarantee that you turn a temporary dip into a permanent financial hit.
And that brings us to our final takeaway. I want to leave you with a simple but really powerful way of thinking about how the stock market moves, and I call it stairs and windows. But first, let's get some vital perspective here. A market correction, that's a drop of 10% or more, happens on average every 1.5 to 2 years. They are a normal, natural, expected part of investing. And even after this recent scary drop, the S&P 500 is still up over 9% for the year. This isn't some kind of catastrophe. It's just volatility doing its thing. And this quote just brilliantly illustrates the feeling of that volatility. Market gains are often this slow, steady, almost boring climb, like you're just taking the stairs one step at a time. But the drops, they are sudden, they are sharp, and they are gut-wrenching, like jumping out of a window. The fear you feel is real because the descent is always, always faster and more dramatic than the slow climb up. So, I'll leave you with this final thought. We've spent a lot of time recently climbing a very, very high staircase. And that long, steady climb makes the next window jump pretty much inevitable. So the question isn't if it's going to happen again, but when. And now that you understand why it happens and you have a game plan, are you ready for it?